The following is a presentation of TFNN. It is now time for the Diagnostic Trading Hour with your host, Darrell Martin. Now, Darrell Martin.
All right, folks. I'm your host, Darrell Martin, here with the Diagnostic Trading Hour. And if you have any questions, feel free to give me a call right now. You can reach me at 877-927-6648. Again, that's 877-927-6648. And want to remind you, if you haven't done so already, we have our free live in-person training workshop coming right up. And all you got to do is go to TFNN.com and click on Free Live Workshop. Click on that right there, and then you'll get the details. It's going to be from 8:30 to 12 on September 29th in Tampa, Florida. And it's going to be there at the Hyatt, the Grand Hyatt in Tampa Bay. And you'll be able to, come on in and ask us all the questions you want. We're gonna have Dan Cook from Nadex. We're gonna have Tom O'Brien talking about identifying the trend and going into setting up the trade. I'm gonna go into the diagnostic trading formula, and I'm gonna go into Nadex spreads and binaries. And then me and Tom are gonna come together, and we're going to combine risk and money management, showing you different trade setups and how you can apply the risk and money management of Nadex. And it's going to be a powerful, powerful event. This event is free because Nadex is sponsoring and paying for it. So don't miss out. If you're going to be in Tampa on September 29th, go ahead and register. Reserve your seat. Once it's full, and we do expect this thing to fill up. So go ahead and check that out. And if you haven't got one already, make sure to hop on over, and on the homepage or really anywhere there, you'll see the Nadex banner. Click on Nadex and click on Create Account. You can get a demo account or a live account. With a demo account, it takes about 15 seconds to get set up. And again, click Create Account, and then right under Start, you'll see Want to Test Drive. Click on Open a Demo Account, and you'll put your username, first name, last name, phone number, and email address. Hit Apply for Demo. You'll immediately get sent a password, and then you can log in with that password, okay? After you've done that, then you just go up here and you click on Log In. You can log right into your account. And then for a live account, it's only $100 to fund the account. There are no commissions. There are exchange fees. The exchange fees are very reasonable. They're 90 cents a side per contract, and they actually get capped at $9. So whether you do 10 contracts or 100 contracts, it's still only $9. And if your trade has maximum loss on the trade, there are no fees at all on the way out of the trade. So you just let the trade expire out, and you don't have to worry about it. So it's a really, really great deal. Only $100 to fund an account. It takes about 5 to 15 minutes to set up, depending upon how fast or slow you type. And really not that much information. And fill that in, quick start, and get going, and you'll be ready to trade. And so that's sort of a quick summary right there. I want to do a quick wrap-up for you. And today we're going to talk a little bit more in detail at one of our listeners' requests. We're going to be going in and looking at the hedge strategy. And, definitely here to answer questions and things like that you may have. And let's see here, pull up some details. We'll look at where the market's at, where the market's been, where the market's going, and all of that fun stuff. So right here, if we go over, and I'm going to go ahead and check out the market right now, we got the S&P sort of leading the way. It's actually up 8 points on the day. We got the Russell up 4. We got the NASDAQ up about 7 points, and we got the Dow up 96. So basically, it's sort of gaining back what it lost yesterday, really at the bottom line. That's what's going on. So not really much of a move. Went down a little bit yesterday, going up a little bit today, and the whole market's really just setting up for what's going to be happening tomorrow night, or really this coming morning, Wednesday morning. And so really not in the night, this coming morning, massive announcement coming out. And it's going to be huge, and we're going to see how that impacts the market and how that impacts the Fed itself. And we'll be talking about that a little bit more. We got copper right here. Looks like it's up. It's barely moving. So, it's just up 0.0065. We got gold up $1.70. We got silver down 0.08, basically flat. So metal's really hanging out and waiting to see what's going to be going on with this announcement coming up, early tomorrow morning, late this night. And we got natural gas. It is up $0.172. So it is up insanely huge. And that is a massive move on natural gas, my goodness. And then looking over at oil, it's up 20 cents. We got corn down 2.75. Not really a big move on corn, nor soybeans down 7.5. Looking over at the Aussie dollar, It's up quite a bit, up 114 pips. So we got the euro up 93 pips, and we got the pound up 68 pips. So a lot of optimism, a lot of hope there that we're seeing reflected in the currencies, and we may see those hopes just as easily dashed, depending upon how the ruling comes out. And it ought to be coming out, my estimate, based on just the history of when these reports come out, is going to be somewhere around 4 a.m. So what am I talking about? What report is coming out? All right, well, the German Constitutional Court is going to be making their announcement, making their ruling on whether or not the ESM is constitutional, the European Stability Mechanism. And basically that's the license to print unlimited money, okay? And it actually puts every single Euro member 100% on the hook for every single Euro member's debt. So Germany is 100% on the hook for Greece, Spain, Italy, France, Portugal, Ireland, on down the list. And so is every other member. So that way, basically the wealthy take care of, or the prudent take care of the imprudent. And that's pretty much how it's going to work out. So the problem is that is a violation of the EU Constitution, okay, the whole thing they put together. And it is a violation of the German Constitution. So if they ruled as a constitutional thing by who knows what, sort of like passing certain recent bills in the Supreme Court based on them being a tax. So we'll see if they do slip it by, or if they say, no, not like this, or no, not at all, or hey, go ahead. So it's going to be big. I mean, there's a lot at stake, and there's a lot of sentiment that is going to get passed. So, the bottom line, it really won't probably delay any of the bailout funding for things like Spain and France and Italy. What will delay the bailout funding is they're not agreeing to any of the austerity measures, so they've already said they don't want to. And so, it's really, really going to be interesting how that works out. We'll talk about that a little bit more and see, how it puts out. But basically, they have said that they are going to issue their announcement. There's all sorts of additional complaints and things like that. But they have said that they will proceed as scheduled. And despite, all the complaints and everything else, they are going to go ahead and make their ruling. So unlike last time when they put it off, they said they are going to do it. And hopefully we'll see a nice big move. And I'm hoping, they need to say no. So countries need to take care of themselves. But we'll see what they say, and we'll see if they violate their own constitution by ruling it constitutional. And like I said, I wanted to look at one of our listeners yesterday called in. They said, hey, I really like you to go over, the hedge strategy and talk a little bit more about that and sort of lay it out, step by step. And so what we're going to do is, I believe that was Edwin, called in from San Francisco asking for that. So we're going to go into that a little bit today in more detail and, say, hey, how does this work? And so what I'm going to do is I'm going to pull up, let's see here. There's a lot of things to pull up. One of the things I do want to look at is just natural gas real quick before we even go into that. And just so you can see this chart right here. I mean, it just, bam, just took off out of the gate. It's been going up ever since. So really, really interesting big rise there on natural gas. But now let's go ahead and let's check out looking at the hedge strategy and how that works. Okay? And so on the hedge strategy, what we're going to do is I'm going to log in over here on a Nadex account. So if you want to follow along, make sure you do have a Nadex account. And we're going to pull up, I don't know, let's pull up the Russell. All right? So we got the Russell 2000 here. And I'm all loaded up and geared and ready to go. And I'm gonna drop everything, all these indicators, all this stuff off of here. Just keep it really simple. Okay? And sort of looking at where the Russell's trading at right now, and what can we do based on that. So now once we have that, the next step is I'm gonna, like I said, hop in. You want to have your Nadex account, and I can shrink that down so that way I can look at a couple things at one time. Over here, and just sort of seeing, where the Russell's trading. So the Russell trading at 841.40, and pull that up. Make sure we got that. Yeah. All right. So good. All right. So we got the Russell right there, and we got to decide. Okay. So now what we're going to do is going to go over to hedge. If you want to hedge the Russell 2000 futures, okay, because the advantage of using the futures, the biggest advantage being that there's no cap on your profit, okay? So we're going to go through a few different ways to do the hedge strategy. So the first one we're going to go through is one, to combine the futures with your Nadex spreads. So the first thing we know is we need to go to Indices Bull Spreads. We need to go to US Small Cap 2000. All right, and these are the spreads that are available for the Russell. And we got to take several things into consideration when we do the trade. The first one is, how many spreads does it take to hedge the futures contract? Well, the Russell ticks in 0.1, and as we can see, if I just pull up to say the master spread over here, it also ticks in 0.1, so 0.1, 0.2, 0.3. Now, every single spread on Nadex, every tick is worth $1. Okay? So again, every tick is worth $1. And so if it moves from 0.1 to 0.2, then that's a $10 increase in value. If it moves from 0.1 to 0.0, it's a $10 decrease in value if you're long. So now over on, it's a $1 increase or decrease in value for 0.1 to 0.2. So now on the futures, it's $10. So every tick is 0.1. On the futures, every tick is 0.1 on Nadex. On Nadex, every tick is $1. On the futures, every tick is worth $10. So if every tick is worth $10 on the futures and it ticks in 0.1, and every tick is worth $1 on Nadex and it ticks in 0.1, then how many ticks on Nadex, or how many spreads on Nadex do you need one tick for it to equal $10 like on the future? Well, the future's $10 and the Nadex is $1 for one tick each. Then you need 10 spreads to hedge. Okay? So you're going to need 10 spreads to hedge over on Nadex. And there's a lot of different ways to do it. I use a scanner. We're going to be bringing that scanner out to you live soon. And I'll go ahead and let me pull it up. I'll show you what it looks like. Okay? And we'll just see, what spreads are currently available for hedging. And let's see here. Pull this up. And I'll open that up. And then we'll have to, basically what we can do is, whether you use the scanner or not, you can still do it. Okay? So you know what I'll do? I'll bring the scanner up here in a second. First, I want you to see exactly how it does work, so that way you can also do this yourself. So over here on this page, go in and just look at, and you want to find one that has a close floor ceiling. So let's say we're looking at this and we're thinking that it had to pull up, and it's probably gonna, let's just say we think it's gonna go ahead and go back down. All right, and without diving into a ton of technical analysis, just keeping it simple. Okay. If we think the market's going to go down, and we just sort of see, are there any spreads? Okay, here's the simple answer. Are there any spreads where the ceiling, if I want to go short the future, where the ceiling, obviously we want that to be as high as possible, because that's going to give us a huge hedge. And to make that hedge work as profitably and as fast as possible for us, we want a floor, okay, on the spread to be as close as possible to where the market currently is trading at. So when we come back, we're going to go through and we're going to look at each one of these and figure out which the best one is. Stay right there.
Kate Stalter's exciting newsletter, Low Priced Leaders, has just launched, and now is a great time to get a 2-week free trial. Every Wednesday afternoon, Kate sends out her weekly newsletter to her subscribers, where she focuses on small cap stocks with market caps under $2 billion, as well as low-priced equities with share prices ranging from $5 to $12. Kate tracks a variety of stocks with a combination of strong technical support and solid fundamentals. Many of the stocks featured will be recent IPOs. These newer issues are often some of the biggest price gainers in the market and provide an excellent opportunity for substantial gains if timed correctly. You can catch Kate Stalter live on Tiger TV with her small cap roundup every Tuesday and Thursday at 11 a.m. Eastern Time, and visit TFNN.com right now to get your 2-week free trial to her brand new newsletter, Low Priced Leaders, while locking in the low introductory monthly rate of only $37.50 per month, almost a 50% discount. Act now.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, Kate Stalter, David White, Larry Pezzamento, Victor Jones, or Darrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure, 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
Millionaires are made every day. The fact is, living your dreams is possible. Someone, somewhere is going to get rich. My recommendation is let that be you. Each day, someone is making the decision to better themselves and creating a plan to fulfill their financial dreams. Let that be you. The key to turning dreams into reality is to take massive action. Let that be you. I'm Steve Rhodes, co-host of the Money Master Show with Tom O'Brien, seen daily at TFNN, and I can help you with your journey to great wealth. I'll show you how to create the ultimate financial edge, a set of tools, insights, and strategies that are part of my daily newsletter service, Mastering Probability. You'll have direct access to me by phone, email, and my private library of trading and investing secrets for 30 days with an unconditional money-back guarantee. I'll take your trading to the next level. Click on my name, Steve Rhodes, on the homepage at TFNN.com and turn your dreams into reality. Mastering Probability, folks. Let that be you.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
All right, so here we go. So we're looking at this trade here. We're trying to get the setup, figure out exactly, what we want to do, and we're looking at the small caps. And down there, there's different markets you can do this on. Each one of them has their own ratio. So on the U.S. Small Cap 2000, we talked about how the ratio is 10-1, and we're wanting to basically sell the future and buy the spread. Okay, we're going to buy 10 spreads to hedge one future contract. And so now we want to find out, what's the one we can do with a low risk and give us the ability to have a good hedge with time to expiration. So out of the ones that are available, I'm looking over several different ones right now. And let's say we want to check out, one of the ones I'm looking at is the, 200 point wide, the 8 a.m. to 4:15, okay? And I'm looking at 840 to 860. So that 840 obviously pretty close here to 860. And our risk on this trade is pretty small. The risk on the trade is literally only the difference between where we buy the spread and sell the futures. So if you look at buying the spread, what is it going to cost? All right, well, the spread will cost 842.8, and the future contract right now is 842, so 841.9. If I go in, and if I want to get it more accurate, I can go in and I can pull up a DOM to get the exact, versus the quote on the chart there. So I'll pull up a dynamic super DOM. We'll get the price just right on the money there. And let me see. Let me load that over and change it to the Russell. And on the Russell, yeah, so it's showing good for me. Okay, so on the Russell, really the risk here is the difference between the two. All right, so if I go in and I buy at 842.9 and sell at 842, then I got 0.9 ticks. Every tick is worth $1, so I have a $10, risk. I have a $90 risk on the trade. So 0.9 is 9 ticks because it ticks in 0.1. So there's a $90 risk on the trade. That's a 1 point stop loss, basically, not even a 1 point stop loss if you're deciding to go short on the futures contract. Okay, so it's a very, very tight stop loss. I mean, I move up to 943 would knock you out. So this way, you don't have to worry about getting knocked out at that price level. And so to see sort of what this looks like on a chart, I'm going to go on here and I'm going to add a drawing tool. And yeah, what we'll do is we'll switch this over. We'll just look at, like, say 5-minute bars. And let's see here. We'll go on. And let's see. Let's put let me update my settings for you, make it a little easier to see on everything on the chart for you. I'll come back to that here in a second. So the summary is if I go in and I add the rectangle, and I do that from 840, okay? And I pull it all the way up here, and I can click on this to, edit my rectangle. It's a little easier to just sort of draw it and then edit it. And so we got a box that we're looking at of, again, that's 840 to 860, okay? So starting at 840, and then going all the way up to 860. And I hit apply on the trade, and then basically what this shows is that this will make money all the way up to 860, okay? And, I can go back, I can change my chart up, whatever, I can change my time frame, hours, whatever. And, but I have unlimited ability to make money on the way down on this trade over here. And so that way, whenever the Russell gets below this price level, okay, it basically a point below it, because remember, I'm risking 0.9 ticks, so once it gets below at the bottom of the box, and that's the key, all right, it has to be outside the box for your future to make money and your spread to stop losing money. So once it gets 0.9 ticks, 1 point below the box here, then it's unlimited profit. But it could go against me all the way up to 860. I'd still only lose $90 on the trade. And, possibly even less than that depending upon what your fills are. But basically, you're looking at a $90 risk on the trade. And so that's a, really, really good trade right there for you that you can take advantage of. So that is one way to hedge. You simply buy the box and sell the future with the box as close as possible to where the future is. Or if you want to buy the future, okay, then you buy the future and sell the box. So what would that look like? All right, let's look at that next. So let's just say we want to do the same spread as an example, okay, the same group. We've got to move our box way, way down. And we'll move it down here to 840, okay? And we go, okay, well, what would the risk look like on this? And, there'll be different boxes, so you can choose which one you want. And the risk on this one would be, going in and, let's say, buying at 841.9 minus 839.2, give you a 2.7 risk. So a little more risk on that trade. There might be a better option. We'll check it out when we get back.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. You've heard Tom O'Brien on the air, and you've seen him on Tiger TV, as well as being featured as a regular CNBC guest and contributor, and now you can have access to his expert trading advice each morning through his daily trading newsletter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, gives traders, investors, and money managers a thorough strategy for trading stocks, options, and indices every market day. Market Insights comes out each market day before 9:30 a.m. and provides traders with Tom's daily commentary, opinion, and specific trade recommendations on the markets. Using advanced Fibonacci methods, volume indicators, Gartley patterns, candlestick charting, gaps, and market timing, Market Insights will give you specific trade recommendations including entry, stop, and exit prices. The summer is over and traders are back. Get your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Smith Barney. Simply picking the right stocks is not enough. Research has shown that choosing the right proportion of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley Smith Barney believes that a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what asset allocation and a Morgan Stanley Smith Barney financial advisor can do for you. Call Angela O'Brien, First Vice President and Certified Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Smith Barney, LLC. Member SIPC.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
All right, welcome on back here to the Diagnostic Trading Hour. And as we're looking at this one trade right here, we were seeing that the risk right now, and it may even be a little less. The closer it is, the cheaper it's going to be. And we can see that right now if we got in and we bought at 841.7 and we sold at 839.1, now risk could be 2.6, and now it's $10 less risk. So the risk goes down the closer it gets to that floor or ceiling. And we can see, there are some other ones that might give us a better trade-off. Well, here's one that has a ceiling up at 841. So what would the risk on, or a floor, I'm sorry, ceiling up at 841, and there's a floor at 841. So with the ceiling at 841, since we're selling the spread, buying the future. So if we bought this one at 841.7 is what we're buying the future for, and we're selling the spread at 839.9, our risk is 1.8. We've lowered our risk. Now we have 1 hour less time to be right because the other one expired at 4:15. So $180, that sounds like a lot, but again, that's only a 1.8 stop loss, but it actually will stop you all the way down on this trade to 834. Okay, so it gives you a massive actual true stop loss, meaning the hedge will make money down to 834 while the future is losing money. So now you have time to be right. Now, one of the advantages, this one's out of the money. What does out of the money mean? Basically, where the market's at is above where the box is at. So we actually just have to move this box up a little bit, right? So because it's pretty close there. So if we look at the market there, it's 841. So we can move it down a little bit more, put it right at 841. So it's out of the money. What's the advantage of being out of the money? Well, it'll actually make money faster because it's already out of it. So the only risk in the trade that it has to make back is that difference. And so you can see right here, 841 minus 839.9. What is that? That's 1.1. So it's a very, very, very small risk. And so it just basically has to move up a point, and it's making money like immediately after that. So that's a big advantage of when you have a trade that is out of the money, is it'll actually make money faster. But at the same time, it'll usually have a little more risk than one that's a little bit in the money. Like the long box we were looking at was in the money, had to move a little further, but had less risk. Anyways, the summary, what do you need to get from all this? You buy the future, you sell the equivalent ratio of boxes. Or you sell the future, and you buy the equivalent ratio of boxes. And this gives you the advantage of unlimited profit potential on your futures trade. Another advantage is, let's say the market does shoot up, 3, 4, 5, 6 points, okay? And you decide to go ahead and close out the trade. Well, when you close out that trade, then you could leave your spread on. And if the market comes back down and falls into that before expiration, then you could actually end up making money, okay? So, you put the trade on, and let's say, you had a little higher box on right here, and you bought, and it shot up, and you closed out, you took off a few points of profit, and then the market came back down, and we'll just say the spread, expired right there. Well, if you got in, we'll make it like this, and you bought, you sold out, you took profit, it fell back down, then the spread could make money and the future could make money. So in both directions, you could actually make money. So if your box is at maximum loss, don't close it out. You can make money in both directions. Okay, so that's the hedge strategy when you're using the spreads. Now, you don't have to combine the spreads and the futures. You could just do the futures. All right? So if you were, you could just do the spreads. To do the futures, you have like this unlimited risk, right? So you go and you could just do the spreads. So let's go in and let's look at something that's really close to the market, and we'll find, there's a lot of different ones, maybe an in the money one or whatever. Let's see here. We're at 841.8, and we can just literally look at all the options. So 841 is what we're looking for, as close to that as we can get. And we got an 840 right there. We literally have an 841 right there. Okay. So let's say we want to buy, and so we're going to look at the 841 to 848 trade. And so we're over here. We're just now getting in, and I'm going to edit this box again. I'm going to make it a 841 to 848. Where did I get those numbers from? Well, that's the floor and the ceiling on the box spread over here in Nadex. So do that, and we'll go ahead and update that. Now I can make money all the way up to 848. What is my risk on this trade? Well, I can do the math. It's not really hard math. I mean, if you can add and subtract, you can do it. Okay, so if I'm buying at 842.8 and the floor caps my risk, 841, I have 1.8 risk. So I have an $18 risk on one, which is nice because you can actually do just one, whereas if you're hedging, you need to do 10. Okay, if you're hedging against the futures contract. So, or if I did 10, then it'd be at 18, points, or, at $10 there, so it'd be $180 risk on the trade. And again, I can do the math, or I can just go up here and I can click buy, click one, it'll do the math for me. And, if I do 10, it'll actually show right here, maximum loss, maximum profit. And so the nice thing there is I have defined risk, I have capped reward, but still, how far do I really expect the market to move? Do I really think it's going to move above 848? Could it? By 4:15 today? Yeah, of course it could. Do I expect it to? Not really. And that's where I use things like deviation, my diagnostic deviation levels, where I'm looking over and going, how far up do I expect it to move? And I expect it to be, semi-flat today, basically in the half deviation range, because everything's waiting and pending on the two major announcements this week, being the German Constitutional Court ruling that's coming out at 10 o'clock Germany time tomorrow, and the other reports that are coming out with the Fed funds rate announcement, possible QE on Thursday. So half deviation would be 849.18. So it could potentially get there. It's not an impossible thing, but really that I don't expect much more than that. So I'm just fine with that ceiling, and I have till 3 o'clock. Now, if I'm not okay with that time, if I want till the end of the day, I may have to choose a different spread. So I may have to go over here on Nadex and go, you know what? Let's see. I have the daily 300s, and I have the daily 200s. Well, the daily 200s are going to give me a closer floor. So whereas the daily 300s, my closest floor is 835. Right here, my closest floor on the 200s is 840. And what does 200 mean? It means $200. The value of the spread is $200. So if my risk on the trade is 50, I can make 150. In this case, my risk on the trade is $27. I can make $173. So you can go in with a really small account and you can start trading. You don't have to combine it with futures at all. And you can see, I mean, it's even still pretty good on par right there. We got the market at 841.9, 842, and this is at 842.7 on the buy side, 842.2 on the sell side. So, a little bit of time premium in there, but that time premium is worth it because now you don't have to worry about getting stopped out of the trade. You have until 4:15 for the market to close at or above 842.7 where you bought the spread. If it closes anywhere between 842.7 and 840, then you'll still get some of your money back. Okay, so if it's at 840, if it's let's say it closes at 842 and you bought it at 842.7, you'd lost 7 ticks. You don't lose everything. It's not an all or nothing like a binary at expiration. Okay, it's just like trading the underlying market. So the difference between where you buy and where you sell, where it settles, is your profit or loss. The only difference between it and the underlying market, or I guess there's two differences. One is you have a little bit of premium in there, depending upon which spread you're choosing. The other one is that you don't get stopped out. So you have a floor, so your risk is actually capped. So that's the other way, is you just do the spread by itself. Now, why would you want to hedge? A lot of times, if you look at the prices, a hedge really has the same risk reward as just doing an outright spread. So why would you want to put the two together? Well, sometimes there's not a spread in the direction you want to go. Like, let's say if the market was at 850, for instance, okay, then there's really no good spread to buy. So if you wanted to buy, you really sort of be out of luck. So what you could do, an alternative to that, would be to go in and use the master spread. If we go over here as another example, see, we still got 850 right there. So with the master spread's really easy to find it. It's the biggest one. 70 points, 200 points, 300 points, 500 points. So if you got spreads at 70, 200, 300, and 500, what number is larger? 500. That's the master spread. So you could go in with the master spread, and the nice thing about the master spread is there's basically no premium built in. It's going to be right at the market price. I mean, there may be 1 or 2 ticks. Sometimes there's none, like not any premium at all. And so you can go in and you could literally buy this one for 842, all right? And then you could go over here and you could say sell this one right here. What I'm saying is, as if the market was up at 850. And then it'd be the exact same thing. Your risk would be the difference between the two trades. Okay? And so now, since there is no market where you can buy above 850, right? There's no spread for buying at 850. This would allow you to buy this spread and sell this spread. This spread would hedge you against any losses on the master spread and give you the potential to make money on the way up. Otherwise, you'd have to take on a huge risk to try to buy at 850. So that's where you combine the two together. And in this case, I'd actually call it a straddle hedge. So because in a sense, you're straddling the market. But there's 3 ways to hedge. Put them all together, summarize them. What do we got? We got either combine the future or forex contract, okay, with the spread. Step 1, okay? Step 2, or, option 1. Option 2 is just do the spread by itself, okay? And then option 3 is you don't even have to use the future, but you could use the master spread, and you could combine it with a different Nadex spread in order to hedge yourself. So either the underlying market with the spread, just the spread, or the master spread with a spread. Those are the 3 ways to hedge. And your risk on the hedge is always the difference between where you buy one and you sell the other. That's your maximum risk on the trade to the point where you're hedged. So like if you bought 850 to 820, you'd be hedged down to 820 if you were long the master spread. So your risk is always the difference where you buy one and sell the other. Just think of if you bought a future and then 10 minutes later you sold the future, the difference would be your profit or loss, right? Well, in this case, it's not your profit or loss. It's just that's your risk. So that's your risk on the trade. And then your protection, your hedge on the trade is if you're buying the future or the master spread, okay, your protection is all the way down to the floor of the spread. If you're selling the master spread and then you bought a different spread, it's up to the ceiling of the hedge spread you bought. That's your protection. So you got risk, you got to figure out. You got protection, you got to figure out. And then the other thing is you have how far does it have to move to make money? Okay, your distance to break even. So the distance to break even is basically if, let's say you bought the future, right, or you sold the future and you bought the spread, it have to get outside of the box, okay? Because right now the future is making money and the spread is losing money. Future is losing money, spread is making, future is making money, spread is losing money. So future is making money, spread is losing money. It gets outside the box, future is making money, spread's no longer losing money, okay? So now it can keep going, and that's where it starts making money. And it has to go a little bit outside the box. Whatever the difference was between where you bought the spread and sold the future, that's how far outside the box it goes. Now, if it's still, let's say you start outside the box, so like one of the examples where we had it right here, then it only has to go the difference between where you bought one and sold the other. Okay, so if there was, like, say, a 10-tick difference between where you bought the future and sold the spread, after it moves 10 ticks, 1 point, then it's profiting at that point. And if it stays flat, then your total risk is 10 ticks. Okay? If it goes down, your risk will be from where you bought one and sold the other. So, I mean, it actually is, it seems complicated, but you just have to sit down and start playing with it. And what are the steps I suggest? 1, I suggest first you start with a demo account, okay? 2, start with just the spreads. Okay, don't worry about hedging until you have, if you don't understand the box, you're not going to get the hedge. So just start playing with the spreads and draw the boxes on your charts, okay? Draw their ceiling, their floor, and their time to expiration. Just about every charting platform that's desktop-based ought to have a rectangle drawing or box drawing option on it. So draw them on your charts. It makes them make a lot more sense. And you want it to actually go to expiration. So you want this thing to literally go to 415. Okay, and like on here, this is Ninja Trader. I can go in and I can say, I want this to expire at whatever time. So if I want to expire at 4:15 or 3:15, I guess Central Time, 4:15 Eastern, then I can go in there, click that, and it'll draw it out. So that way my box actually, not only will I see the floor and the ceiling, but I'll also see where it's at. So if I go in here and let's say I'm buying this box, I know, hey, I can't lose any money below this. I have maximum profit at this point. And if no matter where it settles at, it'll automatically give me my P&L. It's like closing the trade at that price where it settles. Like, so if we get here, then it's going to give me it's going to pay out my profit. If we're down here, then it'll give me back a little bit of the risk capital I put up. If we go down here, I have maximum loss. All right, it'll take care of that for me. But by drawing the ceiling and the floor and the time to expiration, it's really easy to see where I can make or lose money inside that box. And once you got down the box, then add in the future or the forex. Okay. Or add in the master spread. The main advantage to, and sort of like, why would I do one over the other? Well, spreads by themselves, you can do smaller quantities, and it's a lot simpler. Okay, and it takes less money to do them. So that's the advantage of the spreads. Less money is required, and they're simpler to do. All right? The hedge will give you less dollar risk. Either one of the hedges will actually be less dollar risk, but will require more capital. All right, so whether you do the hedge with 2 data contracts or you do the hedge with 2 spread contracts. So when we get back, I'll go ahead and I'll wrap up the benefits and basically the strengths and weaknesses of the 3. I'll compare them side by side for you so you know which one you want to do. Stay right there. We'll be right back after the commercial break.
You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil's subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to check out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday, Wednesday, and Friday, 11 a.m. Eastern, on TFNN.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
All right, folks, welcome on back here. Okay, so we're going to go through basically the benefits of each and just want to re-summarize that for you. All right. So if you're going to do the hedge trade, you can do the hedge trade just by doing an outright spread because you're automatically hedged because the floor and the ceiling of the box spread, okay, on Nadex. The advantage there is you can do a smaller quantity with less money. It's simpler, it's easier, less money is required. However, there may be a little more risk if you compare them apples to apples, okay? That's the spread trade. You have to be able to get that with the box spread. You have to do that trade first to do the others. So it's automatically step one, at least on the demo account, okay? Next, we have up the futures or Forex market with the spread as a hedge. The disadvantage, that will require more money, and it is a bit more complicated. The advantage is there's no cap on your profit, whereas the spread by itself, there is a cap. So with the hedge being the future and Forex with a box, there's no cap on your profit potential. Also, there's often lower risk because you're not risking any intrinsic value. If you're in the money, you're only risking extrinsic value. So time value is the only risk if you're combining the two together. The third option is a Nadex, a master spread, or one of the other spreads, but usually the master spread with a Nadex spread hedge. So basically combining two Nadex spreads together, but being directional, not like a straddle where you're buying one right above the market, one right, and selling one right below the market, but actually having two on. And the advantage there is that everything's in one account. So if you lose money on the master spread, you're making money on the other spread. When you close both out, the money's in the same place. All right. Also, you can do smaller quantities than you could by doing, just say, the future and the spreads, but it will require more money than just the spread by itself. You'll be risking less money than the spread by itself because you'll only be risking the extrinsic, not the intrinsic value. So there are a few different things, and you sort of have to go through those and almost hear them a few times over. So you might want to listen to the archive and replay this piece. But I'll re-summarize it one more time for you. So you got the box spread. Easier to do, less money required, a little more risk, but total less risk because you can do a smaller quantity. All the money's in the exact same account, simplest trade. Box spread with the future or with Forex. Okay? Well, if you do that, you have to have money in two separate accounts. So that means you have to have enough money for the drawdown in the futures account while you're making the money in your Nadex account, and you may have to move money back and forth. It's a little more complicated, but it has unlimited profit potential. And it also will not be risking intrinsic value if you're in the money on your box. So if the market's inside the box, there's no intrinsic value risk. Only the time value is being risked, so there's less risk than just the spreads. But you will have to do usually more spreads on everything but Forex. Forex you can do 1-to-1, but on all the other futures contracts, I mean, you're looking at 5-to-1 all the way up to 50-to-1. Okay, so more money will be required. Third option, master spread with a Nadex spread. You can have all the money in the same account. Less money is required than doing, say, a futures and a spread, but more money is required than doing just a spread. You'll not be risking any intrinsic value on the spread. It will always be in the money at some point. So, just depending on how you're putting it together. But I guess you could do an out-of-the-money one. But if you're doing in the money, only risking intrinsic value and all the money again being in the same account, and really probably the best of all worlds if, there's another spread that's not a better option. So you just got to compare the three together. If you're not comfortable with doing futures, then definitely master spread to spread or just spread. If you want to branch out from just the spread, start checking out the other ones. And the biggest advantage of combining the master spread to the spread is you can make that synthetic strike when there's no short available or no long available. Then you could combine the master spread with a hedge trade, and you actually can make your own spread. All right, well, I hope y'all got a lot out of this. Y'all have a great day. I will see you tomorrow, 12-1. Watch out for that announcement. It is coming out tonight, and it could rock the markets. It will impact the Fed decision on Thursday.
Time is the great equalizer of all mankind. Time doesn't care about winners or losers, who succeeds or fails. Time only cares that you played the game. Question: are you playing the money game? Is your money working as hard for you as you are for it? I'm Steve Rhodes, author of Mastering Probability, a daily trading and investment newsletter service, and we're celebrating our 1-year anniversary. In year 1, we generated a 30% profit. Plus, I provided 26 hours of live coaching to my clients. My daily newsletter service is available by 8 a.m. each day and covers the stock, futures, currency, and commodity markets, along with all the current patterns that you can trade. Each newsletter is packed with education, and it's yours for as little as $3 per day. And for the next 30 days, you can try it risk-free. Click on my name, Steve Rhodes, on the homepage of TFNN.com and begin your journey to great wealth today. If you're waiting for a better tomorrow, remember this: today's tomorrow will soon be yesterday, and your clock is ticking. Mastering Probability. Now is your time.